Ever wondered where to invest, mutual funds or stocks? It's a question that frequently pops up in the minds of individuals looking to grow their wealth. Today, we're going to dive into this topic and shed some light on these two popular investment options. Investment, as we know, is all about putting your money to work. It's about making strategic decisions that have the potential to multiply your wealth over time. And when it comes to investment, two options often stand out: mutual funds and stocks. Mutual funds and stocks both are powerful tools for wealth creation, but each comes with its unique set of characteristics, benefits, and risks. This often leaves potential investors scratching their heads, wondering where to put their money. But don't worry, this confusion ends today. By the end of this video, you will have a better understanding of both investment options. So, let's get started on this journey of financial enlightenment. So, what exactly is a mutual fund? You may have heard the term, but what does it mean? Well, let's dive into it. A mutual fund, in its simplest form, is a pool of money collected from many investors, just like yourself. This money is then used to buy a wide range of securities, such as stocks, bonds, and other assets. The beauty of a mutual fund is that it allows you to own a piece of these many different investments, even though you've only invested in the one fund. This is what we call diversification. Now, why would you want to be diversified? Think of it this way: if you put all your eggs in one basket and that basket happens to fall, then all your eggs break. But if your eggs are spread out in different baskets, if one basket falls, the others are still safe. In other words, by spreading your investments across a variety of securities, you minimize the risk of a single investment failing and causing significant loss. But who decides where this pool of money gets invested? That's where the fund manager comes in. Mutual funds are managed by professionals known as fund managers. These are seasoned experts who study the market trends and use their knowledge to make informed decisions about where to invest the fund's money. They're the ones who are up at the crack of dawn, poring over financial reports and following market news to ensure your investment is in the best possible hands. The main purpose of a mutual fund is to provide a broad exposure to a variety of investments, offering a balance of risk and return. They are a popular choice for those who are looking for a hands-off approach to investing, as the fund manager does all the heavy lifting. So, to wrap it up, a mutual fund is a type of investment vehicle that pools money from many investors to invest in a diversified portfolio of securities managed by professional fund managers. It's like getting a slice of a much larger investment pie. Mutual funds can be a less risky choice since they spread the risk over many investments. It's a way to dip your toes into the world of investing without having to dive headfirst into the deep end. And that's what makes mutual funds a popular choice among many investors. Now let's explore the pros and cons of investing in mutual funds. Diving straight into the advantages, the first one that comes to mind is diversification. By pooling your money with other investors, mutual funds allow you to spread your investments across a wide array of assets. This reduces the risk of your portfolio taking a major hit if one particular investment doesn't pan out. It's a bit like not putting all your eggs in one basket. Next up, we have professional management. Mutual funds are managed by seasoned experts who spend their days researching and analyzing market trends. Unless you fancy spending countless hours poring over financial reports and market data, having a professional do the heavy lifting can be a significant advantage. And let's not forget about convenience. Buying and selling mutual funds is typically a straightforward process, and many funds offer additional features like automatic reinvestment of dividends or regular investment plans. This makes mutual funds a relatively hassle-free way to invest. But as with everything in life, mutual funds have their downsides too. One of the main ones being fees. These can eat into your returns over time. Mutual funds charge management fees for their services, and these can sometimes be quite hefty, particularly for actively managed funds. Another disadvantage is the lack of control. When you invest in a mutual fund, decisions about which securities to buy or sell are made by the fund manager, not by you. If you're someone who likes to be in the driver's seat when it comes to your investments, this might be a turnoff. Lastly, there's the potential for underperformance. While fund managers are experts, they're not infallible. There's always a chance that the fund's investments won't perform as expected, and your returns could suffer as a result. While mutual funds offer convenience and professional management, they may come with high fees and potential for underperformance. So, as with any investment, it's crucial to do your homework before diving in. On the other hand, what do we mean when we talk about stocks? Well, let's delve into that. A stock, in its most basic form, is a type of security that signifies proportionate ownership in a corporation. It's like holding a tiny piece of that company in your pocket. Or to put it in a more relatable way, think of a company as a large pizza cut into multiple slices. Each slice of this pizza, or in this case, each stock, represents a part of the company. Now, why do companies sell these slices or stocks? Companies sell stocks to raise money. They could use this money for a variety of purposes, such as expanding their business, launching new products, or paying off debts. When you buy a stock, you're essentially buying into the future of that company. You're betting that the company will do well, and the slice of the pizza you hold will become more valuable over time. But remember, the value of a stock is not static. It fluctuates based on several factors, such as the company's performance, economic conditions, and market sentiment. If the company does well, its stock might increase in value. On the other hand, if the company performs poorly, the value of its stock might decrease. In essence, when you invest in stocks, you're aligning your financial future with the fortunes of the company in which you're investing. It's a bit like being on a roller coaster ride. There can be exhilarating highs when the company does well and your stocks soar in value. But there can also be stomach-churning lows, when things don't go as planned and the value of your stocks plummet. This brings us to another important point. Stocks, while potentially lucrative, do come with a higher risk compared to other investment options. This is primarily because the stock market is unpredictable and stock prices can be quite volatile. So, to sum it up, stocks represent ownership in a company, and their value can fluctuate based on the company's performance. Stocks can offer high rewards, but they also come with a higher risk. A scene script. Let's delve into the pros and cons of investing in stocks. Starting with the bright side, one of the biggest advantages of investing in stocks is the potential for high returns. Stocks historically have offered more growth potential than many other investments. Over a long time horizon, investing in the stock market could help you grow your wealth significantly. Another advantage is ownership. When you buy a share of a company's stock, you are essentially buying a piece of that company. You become a shareholder, which may entitle you to a portion of the company's profits in the form of dividends, and in some cases, voting rights at shareholder meetings. Lastly, flexibility is another key advantage. With stocks, you can buy and sell at any time during market hours, giving you the flexibility to react quickly to market changes. You can choose which specific companies to invest in, allowing for a more personalized investment strategy. But just like a coin has two sides, investing in stocks has its downsides too. The first disadvantage is risk. The stock market can be unpredictable, with prices rising and falling in the blink of an eye. There's a chance you could lose a significant portion or even all of your investment. Volatility is another disadvantage. It refers to the rate at which the price of an investment increases or decreases for a set of returns. Stock prices can fluctuate dramatically, and the market can shift from high to low quickly, which can be nerve-wracking for investors. Finally, investing in stocks requires extensive research. To make informed decisions, you need to understand the company you're investing in, their business model, and the market they operate in. This can be time-consuming and requires a certain level of expertise. While stocks can offer high returns, they also require more research and come with a higher risk. So, where should you invest? Mutual funds or stocks? We've taken a deep dive into both options, unraveling their unique characteristics, advantages, and disadvantages. Mutual funds offer diversification, professional management, and convenience, making them an attractive option for beginners or those seeking a hands-off approach. Stocks, on the other hand, provide potential for higher returns and direct control over your investments, appealing to those with a solid understanding of the market and a higher risk tolerance. The choice between mutual funds and stocks isn't a one-size-fits-all answer. It's a decision that should be shaped by your personal financial goals, your willingness and ability to take risks, and your level of investment knowledge and experience. It's about finding the balance between risk and reward that's right for you. Remember, the best investment is the one that aligns with your financial goals and risk tolerance. Happy investing.